Credit Suisse is fined for naked short selling. A former trader is sentenced to prison after manipulating penny stocks on behalf of hedge funds. Roaring Kitty is in the clear for now, and we're learning more about the collapse of FTX. Individual investors want a free, fair, and transparent stock market. And so with that theme in mind, let's look at some developments that have happened over the past couple weeks. First up, Credit Suisse is fined by South Korean authorities for illegal naked short selling. According to Reuters, Credit Suisse AG and Credit Suisse Singapore engaged in naked short selling trades that collectively equated to roughly $69.4 million USD. In light of this, the South Korean authorities fined Credit Suisse the equivalent of roughly $19.7 million USD. Remember that Credit Suisse collapsed back in March of 2023, the first systemically important bank to collapse since the financial crisis of 2008, and Credit Suisse was subsequently purchased by UBS. With South Korean authorities' recent fine against Credit Suisse over illegal naked short selling, I'm curious to see if we find out anything else about Credit Suisse in the coming days. In other news, a former trader for a group of hedge funds was sentenced to 3.5 years in prison and ordered to pay more than $215 million in restitution for, quote, participating in a scheme that manipulated penny stock prices to inflate the hedge fund's reported profits. The trader allegedly used various manipulative trading practices, including cross-trading, which fraudulently inflated the value of stocks. Cross-trading is essentially when a trader or a firm uses multiple accounts to trade a security back and forth at the same price. The end result of cross-trading is that it creates the appearance of volume when in fact that volume is artificial. So hypothetically, a firm could establish a large position in a cheap penny stock, then trade a lot of shares back and forth between themselves to give the false illusion of volume. And of course, day traders who specifically look for high volume and volatility would then jump into those stocks for a trade, causing the firm's position in the stock to increase in value and generate profits. Of course, that is illegal. In this specific case, a co-defendant was also sentenced to 6 years in prison after being found guilty by a jury in 2019 of 18 felonies related to his role in the manipulative scheme. Moving on, let's briefly talk about SBF and FTX. According to the Wall Street Journal, SBF's political donations were a family affair. The journal claims that SBF's mother and brother were also involved in routing funds to various political entities. According to the journal, SBF's mother sent an email to Sam saying, quote, "Can I hit you guys up for $92,000 by tomorrow if at all possible to close the gaps on 2 projects we have committed to fund?" To which Sam replies, "Sure." And who did SBF and FTX donate to? Just about everyone. This is a graphic from Unusual Whales, and I apologize for the small font size. The font is so small because there are so many donation recipients to list. And keep in mind, these are just some of the donations that we know of. SBF also claimed that he donated large amounts of money to politicians on the other side of the aisle, but that he did so privately so that the mainstream media would not freak out. And the fact that many of these political donations were made with customer funds is insane. I hope all customers of FTX will be restored and made whole. As I've said before, it's one thing if you buy a cryptocurrency and it goes down in price, but it is an entirely different situation if the exchange takes your money, lies to you, and then collapses due to their own illegal mismanagement of customer funds. And that's what we have here. So again, I hope that all customers of FTX will be restored soon. Now let's talk about Roaring Kitty, GameStop, and the XRT ETF. The recently announced lawsuit against Keith Gill, aka Roaring Kitty, has been voluntarily dismissed without prejudice by the plaintiff. This is good news, but the fact that the lawsuit was dismissed without prejudice means that the lawsuit could be brought forward again at some point in the future. So in case that happens, let me very briefly explain this lawsuit to you. The complaint is 40 pages long, but let me very briefly summarize and simplify it for you. An individual investor purchased 35 shares of GME stock, yes, 35 shares, and a few options at, quote, artificially inflated prices. The plaintiff accuses Keith of engaging in a pump and dump because he sold and/or exercised his call options and increased his position in GameStop by more than 4 million shares. In my opinion, this is absurd. Keith bought a position with his own money. He shared his thoughts about a company he likes. He posted memes. And by the way, you should read the complaint for this lawsuit if you get the chance because it is absolutely hilarious to read them discuss each of Keith's memes and try to explain them in detail. Keith did not tell anyone to buy or sell anything. And rather than just taking the cash from selling his options and disappearing, Keith instead used that capital to purchase more shares of GME stock. The options were going to expire worthless if Keith didn't do anything with them. Anyone who has even a basic understanding of options knows this, and it should not have been a surprise to anyone that Keith was going to dispose of his options, whether through selling them or exercising them, before they were to expire worthless on June 21st. So again, I think the accusations made in this lawsuit are immaterial, and it is important to remember that in case they try to bring this lawsuit again at some point in the future. Now let's talk about the XRT Retail ETF. This ETF is especially important considering Keith's recently announced position of over 9 million shares in Chewy stock. Both GameStop and Chewy are held in this ETF. And on June 26th, one day before Keith's dog post, Chewy stock was the most heavily weighted in this ETF. And according to Chart Exchange, the XRT ETF has a short interest of more than 300%. That is ridiculous. You can call it naked short selling, you can call it rehypothecation, you can call it market makers not wanting to pay fees to State Street who manages the ETF. However you spin the situation, this is just ridiculous. Utterly ridiculous. If you see a security that has a short interest of more than 100%, then sirens should be going off in your head because something is criminally wrong. Many people have been wondering if this ETF has been used to hide short exposure to GameStop. Let me briefly explain how this could work. Hypothetically, if you have two ETFs, one with 100 stocks in it and the other ETF with all of those same stocks in it except for one specific stock, then you could short the ETF with all of the stocks in it while simultaneously going long on the ETF with only 99 stocks in it, and you effectively create net short exposure to a specific stock without making it obvious to the public. And if you look back, historically, spikes and failures to deliver in the XRT ETF appear to correlate with spikes in GME's share price some days later. I'm looking forward to getting the short interest and FDD data for XRT for the second half of June, but unfortunately, we have to wait until the middle of July to get that data. It is absolutely insane that individual investors have to wait weeks just to receive a data point that should be readily available to the public on a daily basis. The SEC cannot honestly claim that it cares about investors receiving proper disclosure about their investments while simultaneously not requiring a daily reporting of short interest and failures to deliver. So with all of this in mind, Credit Suisse fined for naked short selling, a former hedge fund trader sentenced to prison, SBF's political donations, Keith Gill in the clear for now, and the situation surrounding the XRT ETF, let's bring it all home. At the end of the day, what individual investors want is simple, and nothing we're advocating for is beyond the realm of reason. Individual investors want a free, fair, and transparent stock market. We want large institutions to be held accountable for their actions. We want individual investors to have access to the same real-time data from exchanges' better private feeds, which is currently only available to the large firms on Wall Street. We want short sale data to be reported in real time. We want an end to excessive amounts of failures to deliver, and we want entities who fail to deliver on their obligations to be held accountable. We want an end to payment for order flow due to the insane conflicts of interest it creates. There's a reason why so many other countries have already banned it. We want the exchanges to be not-for-profit utilities as they once were. The exchanges becoming for-profit ventures has created so many conflicts of interest at the expense of individual investors. We want increased competition among market makers. And we want all of individual investors' orders to be routed directly to lit transparent exchanges rather than opaque alternative trading systems known as dark pools. Ultimately, it's simple. What we want is a stock market that offers a truly level playing field for all investors. Please leave a like on this video so more people will see it. And while you're down there, please consider subscribing. It's free, and you can always change your mind. Thanks for watching, and hopefully I'll see you in the next video.